You're listening to the Real Estate Runway Podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today, we're going to have a Quattro Roundtable episode with Kim Wendland on the line. She is a partner, a managing partner of Quattro Capital over our asset management division. And honestly, she's been running finance and tax as well for a time. So we'll commend her on that. But what we want to talk about today is really inflation and monetary policy and how it's starting to affect assets and things you need to be looking for as an operator, questions you should be asking as an investor if you're seeing some of these symptoms. And just make sure that your team has a good management strategy to get you through this. And I'm going to give you a little hint. Cash is king right now, not just in buying things, but in operating. Okay. And we're going to get into why that is. Now, if you get any value out of this episode, please subscribe on YouTube and give us a 5-star review on our podcast page with Apple Podcasts. That is the best way to spread the word of the show. They're worth their weight in gold. And look, if you want to apply to be on the show, visit us at thequattroway.com/podcast to apply. And we'd love to hear from you. If you have any sort of feedback, leave it in the comments or hit us at podcast@thequattroway.com. Love to hear from you, get a dialogue going. And if you want to follow us on the socials, we're at Team Quattro Capital. One word, no special characters on all the major socials, or just visit us at thequattroway.com and you can pick it up from there. And let's get right into the episode. I'm excited for this topic. It's going to be a good one. And here we go. All right. Real Estate Runway family. Welcome to another episode of the Real Estate Runway Podcast, Quattro Roundtable Edition. I'm joined today with our managing partner, director of asset management, Kim Wendland. Kim, welcome to the show. We have some really exciting topics to talk about today. Thanks for being here. How's life?
Oh, life is wonderful. I'm just grateful and joyful. But I'm so excited about this conversation. So timely. Way to tee this up, Chad.
It really is. And today we're going to talk about inflation and monetary policy and the impact on your assets, right? And Kim, maybe let's take a start. Like, where do you see where we are today? What's going on? Let's kind of set the stage a little bit. And then maybe we get into how it affects valuations starting off.
Love it. How the economy's doing is a lot about who you're listening to. So either you are digging ditches and building shelters, or you're figuring out how to play the game in the new world. And one of our favorite economists who is focused on real estate, has 40 years of being an economist, Dr. Peter Linneman. And I love the way he describes the economy right now. He just says we have long COVID. The economy has long COVID. And what does he mean by that? Really, what he's trying to convey is the fact that the economy is still recovering from 100% shutdown. I think we all would be mindful to remember that it hasn't been since the days of Noah that the world's economy stopped. So that's a really big event. And in our world where we can send a text message instantaneously to each other or affect an entire conversation nationally with a tweet, the idea of pacing and cycles and timing is difficult because we think this should already be solved by now. So if we think about long COVID, where we are, Dr. Linneman points out first, real GDP is almost, but not at the point it was prior to 2020, which means this fear that we've overheated the economy isn't really true. The Fed, we had a situation where we had a little bit of inflation and then, bam, in 2022, it spiked up hard. Well, interesting that correlated exactly about 2 years after they pumped in $1 trillion. Like it was almost exactly the timing. That wasn't lost on me. And so when you think about the fact that we're really in this long COVID cycle, it made sense that inflation ramped up really fast, roughly 2 years later. In addition, the only control the Fed has to reduce that inflation is really cool down the economy. So that's reduce the money supply. And the other lever they have is to increase interest rates so that we all stop buying so much. But the demand has been so great. Every time they raise it, we all as a nation kept buying. But now it's beginning to hurt. we're finally here in April 23, beginning to see some fluttering of the impact happening. And honestly, in March, the Fed kind of broke the banking system. So they pumped a bunch of money back in saying, whoops, hold up. So we're in this period where the patient is recovering, but we're not out of the ICU yet. And as soon as I put that in my mind, the context is a whole lot easier to comprehend.
Yeah, that makes a lot of sense, Kim. Thank you for kind of walking that road. A visual that I love to have is everyone who listens to me here loves visuals, or they're forced to because I use them all the time. But when I think about the two levers that the Fed has to try to control the economy, right? I think about Elmer Fudd sitting in a bulldozer on Looney Tunes, right? He has the two levers. One of them drops a wrecking ball and the other one raises a chain. But it's interesting to think about. And the two levers, quite frankly, are interest rates up, down, money supply up, down. And it's very interesting that all we're feeling is the repercussions of said lever movements way back in 2020 and even here today. So it's interesting that I love to put myself out there and make predictions. I don't think we're going to see a massive amount of the interest rate lever being moved upward anymore, simply because, to your point, we kind of broke the banking system already once by removing liquidity and raising interest rates. And so I think they're going to kind of stop that, but we saw we had to put liquidity back into it. So the interesting question is going to be, the patient is recovering, we're in long COVID, but since we can't really do the two things to help us squash the inflationary pressures, perhaps we're in a situation where we just may have elongated long COVID for a while until we get out of this. So like you said, we have to learn to play by the rules that we're in today. And so taking those rules, how do you see us playing the game today? How does this affect our assets, our decisions, our business acumen that we have today?
Well, Chad, that's the real thing. Is like, once we understand what's happening, how do you adapt and overcome? Right. And it's intense. Like, I hope your listeners and our listeners understand that we're living history and we're experiencing things today that people in this industry for 30, 40, 50 years haven't experienced. The economy is literally changing every quarter. And if we have that in our mindset, this isn't a time of change. This is a time of hyper velocity change. You cannot look at the stock market and understand what's happening with assets. They're totally different worlds. And when you're looking to understand how to handle assets, you're looking at two really big vectors. One, your liquidity. And second, the revenue stream of the residents who live there. Those two things are what you have to maximize in order to keep the asset flourishing. But all of that's happening during a time when valuations are compressed a little bit. But let's start with valuations, and then let's move to the rent income ratios, and then let's land on like liquidity and CapEx. So if we think about the valuations, everybody is so anxious about it. And part of the anxiety has to do with the fact that it's the unknown. None of us know, including the Fed, what they're going to do next. And so I gave up trying to predict it. And I really think they have a tough job. If I had to look at the rearview mirror only to decide what major decision to make for a massive economy going forward, no thanks. Don't want that job, right? I prefer more certainty in my life. However, we know valuations have dropped anywhere from 7 to 15%. Let's remember when it was the worst of the worst in the 2008, 2009, we were talking about 35, 40, 50% reduction in valuations. So our valuation drop here is not systemic at all. This is completely tied to interest rates. And you and I, Chad, we always love this phrase, that it's a lender's market, neither a buyer's or a seller's market, because it all depends on what the bank will do when they come to the table.
That's right.
So when it comes to valuation, I say, unless you're having to sell right now, way more important to keep your asset manager's focus on income, expenses, and performance there. because we're in a seasonal time. If the economy is changing every quarter, and it literally is every 3 to 4 months, it's a whole new world. So let's stay focused on what we can control and what we can handle and allow the valuations to fluctuate as they have to with the macroeconomy. Does that make sense?
It makes perfect sense. And I think it really goes to whatever asset value you're looking at. You only lock in losses. Well, there's two ways, right? One, the asset you have goes to zero, i.e. it goes bankrupt. So you lose your money. That's a problem. And that does happen. And like, for example, if you're invested in the stock market and the business goes bankrupt, well, guess what? You no longer have an investment. But, with hard assets, for example, or anything that you can operate, that, again, it only matters if you actually sell the asset. And I'll caveat that. It also matters if you're trying to refinance the asset, right? So if you're trying to do a capital event on the asset, sell or refinance, you got to be paying attention. But as far as, especially if you've locked in fixed rate long-term loans, I think what Kim is saying is quit looking at it. It's bad for your health, and focus on operating the asset better.
Yes. When the stock market's going down, you don't look at it. You reverse your temptation, but
Exactly.
because it's coming back up. And I think that's true of valuations. But where we can focus a lot is the performance of the asset. And there's a significant discussion about recession looming. And to that, I'm like, well, no kidding. We've overstimulated the economy. It has to stop that way. But what's beautiful about this is that it's not a structural problem. This is a sputtering restart of a massive economy, a global economy. So when I keep that context in mind, this is just long COVID, then all I'm thinking about is what is it that we can measure today that will help us make sure that we can stay on track? The number one measurement is our market. If you're in a strong market where jobs are still growing and there is still not enough housing, you're not going to experience much of recession. And for the vast majority of our assets, that's been the case. There is still more demand for the units than there is supply. And why is that? Well, it's because we're 1 million units short. Even with all the construction, we're still 1 million units short in apartment complexes, and we're 3.3 million short in single family housing. So you tie that together in a 100 million population. Not every individual has a house or an apartment. That we cluster in family units. A large majority of people do. And so that volume of loss of housing is what's driving rent. It's what's driving the housing prices. That is the overarching reason why real estate is still one of the most fantastic investments right now. Anytime there's supply and demand imbalance that's working in the favor of the assets, that is a golden season for investors. When I'm looking at rent to income ratio, that's the second factor that is really important. If the average income in the area is, at the best of times, lower than your projected rent, you have a problem. But if you have a value add project where you're raising rents to the current market rate by improving the property, even if that's slightly off 2 or 3%, your investors are never going to experience a problem. That property is going to continue to perform well, especially in light of the supply and demand. If you have a Class B or Class A asset that's like a buy and hold, it's the same scenario. You have the advantage of not having the capital demands. Like, you certainly are not trying to do renovations in the middle of that and do refis. You're going to collect checks, pay rent, pay investors, and live a happy life. That's a golden time right now. For those who are in the value add projects, there's a little bit more work going on, but those are the top two. Those are the top two metrics to be watching and managing too. You want to understand your market, know the strength and weakness of it with the supply and demand. And secondly, make sure that your income to rent ratios make sense going forward.
Nectar understands that raising capital is labor and time intensive, and we exist to solve that problem for you. Nectar provides fast, flexible, cash flow-based financing for experienced rental owners and operators. Whether you need cash for acquiring properties, portfolios, or you simply need it for ROI-generating renovations or expansion of staff, Nectar has your back. Grab your 12-month P&L with debt service and click the link in the show notes below to apply today.
If you to market where the population was going in the right direction, it was growing, the incomes are growing. Okay, the water's rising in the market. That's good. And then also the submarket you go into, the asking rents on your project are not more than 33% of someone's income, i.e. the rent to income ratio. You're probably going to do okay in the recession. But then again, I've seen a lot of deals come across where the rent projections are way over the skis, like to the tune of 50% of the rental income. Like, this is silly because all you're doing is promising yourself delinquency and non-payment because those residents will not be able to handle that situation. And so that's what you're driving home there. And it's so true that the real estate market is local. It is a hyper-local thing. We average it and we try to look at the whole thing, but it is hyper-local. And exactly what you said on the macroeconomic factors, they're going to behave locally, and depending where your plan is related to, that's going to dictate your success.
Oh, you're so right, Chad. You know, to speak to people who are straight up investors, who are not operators, the absolute most important litmus test you can do for whether or not you believe a pro forma is the rent to income ratio. If you can see what the rent to income ratio is and they're well within that, or even if they're close to it, you're going to be fine. But if they're promising greater than that, it's probably not a wise investment.
Yeah, exactly. And so that's just a fantastic assessment on how to kind of relate how we manage the performance of our assets as well. And how do we look at this impact on the value add plans that we're putting together? I guess the CapEx project specifically.
Yeah, for the value add plays where you have a large CapEx, there's significant dysfunction since the SVB Bank and what was the other one? Not Silicon Valley.
Signature.
Silicon Valley and
SVB
Signature
and Signature.
Bank.
Yeah.
Those two. And then Credit Suisse, that's a whole nother different thing. But the two U.S. banks that tripped over the macroeconomics the Fed was throwing at them, those events create what I call lender drama. And the reason I call it lender drama is that it affects us in weird and abnormal ways. And the way that you would have built your project, you would have said, oh, I will do this much work. The bank will immediately, within a short period of time, refund me that money and I will keep going. But the reality is, when there is, quote unquote, blood in the water, banks are the first to close up shop and get in the helicopter and leave. Because losing money for a bank is just not an option. So they're first out, last in. And if you think about that first out, last in behavior, you know, when other peers are failing and banking and lender balance sheets are being scrutinized, you can fully expect and anticipate that draws might not come as quickly as expected. You can fully experience the fact that the lender's scrutiny is going to raise, even if all that scrutiny is buying themselves time so that their balance sheet is right. You have no way of knowing. You're going to answer the mail. You're going to respond to the information with clarity and certainty, but that doesn't prevent them from dragging their feet, making a draw. This is the season, Chad, let me say it this way. These times of crisis are when you learn how the banking system works and how the lending system works. And in the last, let's just look from 2019, 2020, 21, and 22. What were the major banking challenges for real estate? Well, in 2019, slam. Freddie and Fannie had so much demand, they literally ran out of money to loan. And to kind of say, I'm sorry, in early 2020, they dropped interest rates slightly, just to say, yeah, we know we did that. Well, then the entire economy 3 months later in March of 2020 completely stops. Banks evaporate, lending evaporates. It was incredibly challenging time. All of a sudden, June and July, the Fed starts pumping money back in. Oh, we can start doing deals in business again. Flash forward to 2022. 21 was pretty solid, but there was a lot of fear in the market, a lot of the moratorium concerns, a lot of eviction concerns, payment, top line challenges, but deals were still happening. Even through the first half of 22. And by the way, construction draw money was still flowing as you would expect it. As the interest rates began to rise so fast in such a short period of time, the lenders and the bankers' balance sheets have been under stress because their world was upside down. So here we are. This is April of 2023. And we only have one lender that is actually paying their draws the way you would expect it. All the rest of them, it's a new game every day. And all you can do is stay on top of it. The other thing all you can do is make sure that you can backstop as much as that as possible. So the liquidity of the operators and the liquidity of the project is super, super important. Like you might have to step in and pay a few vendors to keep work going in order to handle the delays of those draws. So I feel for the guys in construction right now. And those teams, like they know exactly when their lender is about to disappear and they literally stop work. Well, we're already an ongoing concern that we're not in the dirt. We're like, people live there. So there's no stopping the property. We have to continue. And so staying liquid, staying close to your lenders, understanding and being super responsive to the draw request is important. And then one final thing, because I know I've gone a little long here, Chad, but one final huge important thing. When you submit your draw requests, just start planning to prepare it as though you're trying to get a new loan. Give them the business plan. Help them see your performance. Don't make them work. Make it easy for them to say, yeah, this one's good. I can trust this and go approve it. That's the key, is providing certainty, confidence, keeping the relation positive, and above all else, do not beat up your lender. Those guys are getting beat and punched in the face every single day. Don't be part of that crowd. Be part of the we appreciate you crowd. Be part of the, oh my gosh, you're my most important partner crowd, which they are. Like you would never punch your investor in the face, but people do that to lenders all the time. And yet they're the largest investor in our projects. So I got a little off topic there, but be nice to your lenders. It really helps.
Yeah, in general, that's a core business principle. Don't be a pain to do business with. And when everyone else is screaming, if you're showing compassion and feeding them information that they're going to have to go do anyway and making their life easier, imagine who's going to get, it's almost the opposite of the squeaky wheel gets the grease. So when they're all squeaky,
it is.
It's, oh, wow, I noticed that one's being quiet. Or not quiet, but it's not unruly squeaky.
Be the oil, not the rough part. Maybe that's a better way to say it.
Yeah, maybe that's the analogy. And I think to just completely bring it full circle and do A plus B equals C for everyone here, Kim was talking about, and I think this is core to managing any business, whatever business you're in, whatever investment you're in. The core right now is going to be managing your balance sheet, managing what cash you have, what cash demands you have when you pay them, when it's coming back. And everything she is talking about is if you are spending, aggregating and doing one big draw and then spending, you're going to wind up with a cash problem if your lender doesn't fund immediately, right? And so what she's saying is expect that, because it's probably going to happen. And so draw early, draw often, draw as much as you can, so you're getting little bitty draws that are approved rather than one big one. And that also helps. You can see the cash problem coming faster than if you hold all this work, deplete all your cash, expect it to come back, and then, oh shit, it doesn't. So keep an eye on that, folks. That's really what she's getting at here. And I guess...
Yeah, watching... Just to interrupt you, Chad, sorry, but, keep a strong eye on your cash flow statements. That cash flow statement in the past wasn't near as critical as it is now.
Yeah, and I feel like we have to qualify that, Kim. You just real quickly describe the difference in a P&L and a statement of cash flow. I don't think the listeners will know that, and that's important.
For sure, it's super important. So the profit and loss statement, the income statement, those two words are interchangeable. That's really showing you whether or not you're profitable. But if you're running accrual accounting, as by the way you should be, but if you're looking at accrual accounting, you can actually be profitable and not have any cash. And this is where taking one of those 4-day MBA classes would be really smart right now. If this is a new conversation to you, do the 4-day MBA with either Keith Cunningham or the other guy. I can't remember. Somebody else has a 4-day MBA. But the net of it is you start learning how the relationships on the financial statements are affected. So I'm really getting to your answers. P&L describes profit. Your balance sheet has a line item that says cash, but that's just a point in time. What you need is how much cash did I have when I started the month, and how much cash do I have when I'm starting the next month, and where did it all go? And that statement of cash flows helps you see the ebb and flow of your cash itself when you're doing accrual accounting.
Yeah, and it's very important because the simple analogy that I've learned to use, folks, is if Joe sells 10 trucks and he sells 5 to Chris and 5 to Stacy, if Chris pays him in cash and Stacy pays him in an IOU, his profit and loss statement is going to show that he sold 10 trucks. That's great. He's profitable. But his cash statement is going to show that he only actually got cash for 5 of them. So you see the problem where this could act. And how does this translate to rent? Accounts receivable. That is what you're owed. That is rent that you're due. If not everyone pays your rent, okay, you show you have rent on the profit, but you actually didn't get the cash yet. It's still a receivable. You can get yourself into trouble there, but the same thing goes with the other side of the equation, your accounts payable or things you owe. If you can look like you're making a lot of money here, but if you have, stacking up accounts payable, that's also going to hit your cash very soon. You have a cash problem and you don't know it yet. So just pay attention to that, folks. I beg you.
That is such a good analogy. So many people don't realize they can be profitable and still not have cash. And so the 3 things that you need to watch for cash is your income. Obviously, that's cash coming in. But secondly, are your reserves, because you better have operating reserves for the tough times. And then third is the available capital for improvements. So those 3 things working together, you really need to keep an extra measure of eye on them, because when the banking system can't be as reliable as we always want it to be, we have to fill the gap.
Exactly.
Want to generate higher return and drive alpha for your commercial real estate firm? Now you can with Lobby CRE by 30 Capital. Lobby CRE is an asset management platform designed to manage and optimize cash flow for faster returns and more visibility into performance. Shift your strategy with the market, not because of it. Identify opportunities and mitigate risk now rather than later, and save more than 8 hours per week through automation. Click the link in the show notes to learn more and book a demo.
Well, Kim, thank you for coming on, sharing your knowledge. Any final words of encouragement? I know that it's hard. We do our best to talk about this stuff in an enlightening and playful kind of way, but there's a lot of doom and gloom out there. But what encouragement can you offer to those who may be going through what we've just described?
Chad, I'm going to go somewhere kind of personal on this. For those of you who don't know, there's an episode that described, I literally almost died from COVID. I was down for the count. My family was called to say goodbye. So when I say the economy has long COVID, I know exactly what that means. And even though I survived COVID, it was 9 months later before I could really have control of my left arm. And it was a full year before I felt like I had my full cognitive capacity. So why would I share that? Because long COVID is temporary, not permanent. And with the passing of time, the economy is going to change. But what isn't changing is the fact there's not enough housing. There is not enough housing in single family or in multifamily. And that reality, regardless of the complexities that is coming at us, that fact is only getting worse every single day. Therefore, real estate investing is getting better every single day. That's the macro perspective that I keep in mind that keeps me engaged and investing right now.
It's a long-term play, folks. Keep your eyes on the horizon. And that is episode 4, way back, one of the first few episodes we did of Real Estate Runway. So please go give that a listen. It's an enlightening and encouraging story. So, well, Kim, thank you for coming on, sharing your knowledge, sharing kind of some of the things that we are working to mitigate. And if you're not seeing those yet, folks, here's a premonition for you. You're probably going to, so start thinking about how to mitigate them. And with that being said, we'll have you back on sometime soon to talk about the next current issue we have going on.
That's fantastic. Way to be, Chad. Hey, everybody, keep investing. It's okay. We're going to make it.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.